Hello, everyone. Welcome to Kotak Securities webinar on Let's Talk ETF. Thank you so much for taking out time on a Friday evening, a rainy Friday evening if you're in Mumbai, to come and attend this webinar. Make time for it. Uh, this webinar is part of the initiative by Kotak Securities to increase awareness about ETFs, a product very popular with today across the globe. We have with us, and please welcome welcoming industry veteran Aman Singhania. He's an expert in ETFs. He's the head of product development for indices and research at NSE, and he's basically been in the markets for around 2 decades. His main responsibilities are development of indices on which all of these ETFs are based. These are across all asset classes, and essentially he's the one who is driving the ETF industry, if I may say so, through these brilliant indices that he and his team are creating. So welcome, Aman. It was I fall short of words to introduce you, uh, but I hope I did justice to all your experience and all the world of possibilities that you bring to the ETF world through your indices.
Good afternoon, good evening, good morning to everyone across the globe. And thank you, Aroop, for that wonderful introduction. Not sure if I deserve that, but thank you. Uh, Happy to be part of this webinar, talking about a topic which is so close to my heart and something that I'm passionate about, which is passives and more particularly ETFs. I think India is clearly witnessing an unprecedented growth trajectory when it comes to passive. And I consider myself fortunate that I'm part of this journey where I can witness this growth. So I'll be happy to share my experience today.
Awesome, awesome. Thank you for making time as well. So let's just dive right in. Basically, the attention towards ETF has increased, and we have today customers and people of all different age groups with varied level of understanding of ETF. So let's start with the basics so that everyone can catch up and be on the same sort of level. Uh, what are ETFs and what are the different types of ETFs? Like, let's start from the very basics and get everyone so that everyone in our audience of different age groups, different levels of financial understanding can catch up to the beauty of the world of ETFs.
Sure. So ETF, as the name says, it's exchange traded funds. These are essentially funds which are also traded on exchange. So, there's one conventional way of buying funds through a mutual fund where you go to the mutual fund, give your 1,000 rupees, and at the end of the day, the NAV is published and you get your units of mutual funds at those NAV. So if the NAV is 10 rupees and if you put 1,000 rupees, you get 100 units of the fund. As against that, what if the same fund is now traded on the exchange where intraday through the day you can buy or sell those same units which otherwise you can buy through the mutual fund at the end of the day. So essentially, these are mutual funds which are traded on the exchange. So they are ETFs. You can buy and sell them throughout the day, and that's the essence of the ETF. Now, just to understand this concept better, let's take a step back. Let's go back to the basics of fund management. Broadly, there are two ways in which any fund can be managed. One is the active fund management, another is the passive fund management. The critical difference between the two is the stock selection discretion. So, in an active fund management, the fund manager's primary goal is to outperform the benchmark like Nifty 50. So, if Nifty 50 has given, let's say, 10% return, the fund manager would want to give more than 10%, which could be 11 or 12%. Thereby, the alpha, the excess return that he or she could generate is 1% or 2%. That's active fund management, which involves identifying undervalued stocks and buying them. As against that, there is passive fund management, which is essentially replicating a market benchmark like Nifty 50, for example. So, here what happens is there's no stock selection discretion. The fund manager would buy the same stocks which are part of the index, which is Nifty 50 in this case, in the same proportion as the index. So effectively, you're passively taking exposure to the capital market without getting into the process of identifying undervalued or overvalued stock. So that's the essence. Active is all about trying to outperform. Passive is all about matching the benchmark return. And again, there are reasons why passive is doing well. I'll come to that in a moment. However, within the passive fund management style, there are two vehicles through which you can take exposure to the market. One is exchange traded funds that we're talking about. That's the topic of the day. And other is index funds. Index funds are similar to mutual funds, where you buy or sell at the end of the day through the mutual fund. But ETFs incrementally, as I said, take exposure to the market, and you can buy and sell them throughout the day. So these are essentially two forms or two vehicles, if I can say that, of taking exposure through passive fund strategy. Now, again, critical differences between an ETF and an index fund or an active fund. One is the holding format. The holding format for an ETF is that in a demat account. So you need a demat account for you to trade an ETF. The advantage of an ETF over an index fund or an active fund is that because it is traded throughout the day, you can actually take intraday calls. So, for example, 12 o'clock noon, you want to buy. You think that the price of the ETF unit is lower, or it has fallen, the market has fallen, and you want to quickly buy. This is something that you can achieve by ETF, which of course you can't achieve through an index fund or an active fund, because the transaction that you would do in an active fund or an index fund would only be end of the day. So intraday volatility is what you can play with an ETF. But for that, liquidity of the ETF is very important. So the traded volume of the ETF on the exchange becomes critical here. So while you trade, higher the liquidity, higher is your ability to buy and sell without taking much impact cost. In terms of cost of ownership, which is, there are different costs involved in owning a fund. One is, of course, the fund management fee, which is incorporated into the total expense ratio, TER. Typically, active funds charge anywhere around 80 basis points to 200 basis points per annum, which is the total return expense. Whereas passive funds are way cheaper when it comes to total cost of ownership, because there's no fund management discretion. So there's no fundamental research or technical research that goes into selecting stocks, because the passive fund is replicating a benchmark. And that's why there's no research cost. And that's why the cost of ownership in the form of fund management fee and the total expense ratio is significantly lower. You can take exposure through an ETF for as low as 10 basis points per annum. So that's how cost effective an ETF is, if you were to take exposure to the capital market. In terms of disclosures and transparency, uh, this is another advantage of an ETF, because the ETF is tracking a benchmark, and the constituents of the benchmark, which is, let's say, Nifty 50 or Nifty Mid Cap 150 or Nifty 100 or Nifty Small Cap 250, the constituents are there in public domain. So you know that what the fund is buying and selling. As the stock goes out of the index, the fund also sells the stock, because the fund has to replicate the benchmark at any point in time. So there could be inclusion, exclusion of stocks in the index, and the same is replicated in the fund. And the portfolios are available in the public domain. So the transparency and disclosure of passive funds and ETFs is higher as compared to an active fund, which is disclosed on a monthly basis. So that sums up what ETFs are, how they are different from index funds, and how ETFs and index funds put together are different from active funds. In terms of types of ETFs, broadly it could be based on assets. So, for example, there are ETFs which give you exposure to the equity market. There are ETFs that give you exposure to the fixed income or debt market, And then there are ETFs that give you exposure to commodities or alternatives market. And of course, the fourth category could be the international category, which could also be within equity. Now, within equity, there are again subcategories. One is broad based, also called as market cap based indices. Now, these are the simplest form of ETFs. For example, Nifty 50 is a broad based index. Any ETF which tracks Nifty 50 is a broad based ETF. Here, the selection of stocks is based on size or market capitalization of the company. So, for example, Nifty 50 tracks top 50 companies of India, the blue chip large cap stocks in India. They are selected by free float market capitalization. Nifty 100, which is top 100 stocks by full market capitalization. Nifty mid cap 150, which is 150 mid cap stocks, the universe of mid cap stocks listed on NSE. Or Nifty Small Cap 250, which is the universe of small cap stocks. So these represent different size segments: large cap, mid cap, small cap. These ETFs are called as broad based ETFs. This is the most popular category of ETFs within equity in India and globally. Thereon, there is second category, which is sector ETFs. Now, if you want to take an exposure to a particular sector, for example, financial services, IT, consumer durables. One of the ways in which you can take exposure to these sectors is through a sector ETF. So there are ETFs which are available on banking, financial services, IT, and so on and so forth. So if you take a call that you want to take exposure to a sector, one of the cost-effective ways of doing that is through a sector ETF, for example. Moving on, the third category of equity ETFs is thematic ETFs. So if you want to play a theme, a particular theme, for example, consumption, MNC, digital, Sharia, ESG, these are emerging themes that you would have heard about. And if you want to take exposure to stocks which are digital in nature or high consumption, India growth story, uh, logistics, transportation and logistics, for example, multinational companies, for example, these are different themes. Sharia, for example. If you want to take exposure to stocks which are curated based on these themes, you can do that through thematic ETFs. And then finally, there is strategy ETFs, also called as factor-based ETFs, also called as smart beta ETFs. Now, here the selection of stocks is based on certain factor. Now, what is factor? It's a common attribute across stocks. For example, a factor could be quality. So I may say quality companies are companies with, let's say, high return on equity, low leverage, low variabilities of earnings growth. So essentially trying to identify quality companies through quantitative rules. So that's quality as a factor. Then there could be value. So value is what is cheaper, for example. So here the stocks are selected based on quantitative factors like price to earnings multiple, price to book multiple, price to sales multiple, price to cash flow multiple, dividend yield, for example. So if the selection is based on these parameters, we call it a value factor index. Then there could be alpha, momentum, low volatility, growth. These are, globally accepted factors or strategies within ETFs. Again, we have a host of such single factor and multi-factor indices. One of them is, let's say, alpha quality low vol. It's a combination of multiple factors where selection is based on high alpha, high quality, and low volatility. So if I want a combination of these three, that's a multi-factor index. So this comes under the umbrella of strategy ETFs. So I summed up four categories of equity ETFs. Then there is
Yeah.
fixed income ETFs. So fixed income ETFs is basically an ETF which gives you exposure to fixed income instruments or debt instruments. Broadly,
Okay.
within them, there are two categories: constant maturity and target maturity. Constant maturity is an ETF which never matures. So, it will always be, let's say, 5 year, it will always be, let's say, 5 year residual maturity government security. So, every 6 months or 3 months or on a monthly basis, it will roll over to the new 5 year. So, at any point in time, the maturity of the fund and the index will be around 5 years. That's a constant maturity product. The target maturity ETF is where there is a target date when the fund and the index matures and you get your money back. Something similar to a fixed deposit or a bond, where you buy today a 10-year product, it rolls down to 10-year, and you get your money back after 10 years. So that's a target maturity ETF or target maturity index fund, very popular in India. The story started in 2019. I'll talk about it subsequently. And then there is commodities, which could be gold or silver. Gold has been there for a long period of time. Silver has recently been introduced. You can take exposures to gold and silver through an ETF route as well. And finally, there's global or international ETFs, where you take exposures to markets outside of India, capital markets outside of India, by buying ETFs or funds which give you exposure to stocks listed in US or Europe or Hong Kong, and like that. So that sums up the basics of ETFs, the form, structure, holding format, liquidity, and types. Over to you.
Yeah, thank you so much. This was very, very insightful. I'm sure everyone is like, just got a thorough lesson, and I'm so happy that we are recording this, because anytime anyone ever asks me about ETFs again, I'm gonna just share the link to this video and say, "Ki, here you go. It has everything you need," and we just started. So thank you so much for that. So you mentioned a lot about different types, different sectors, different themes. Uh, what would you attribute to the success of ETFs locally as well as globally? What has been the reason for this rise, and where do you see the passive market, as you called it, heading in the future, domestically as well as internationally?
Sure, sure, sure. So I'll first give you the global landscape and then come to the India landscape, and then maybe talk about the reasons of this
Sure.
great trajectory that it has observed over the last few years, and what we believe will happen going forward. So, globally, if you see, the ETF and ETP, exchange traded product AUM, as of March 2022, has already crossed 10 trillion US dollar. And that's a
Wow.
massive
Yeah.
asset under management by any scale. And, from 2007 onwards, the annual growth rate that ETF AUM has observed is around 20% year on year consistently. This
Wow.
10 trillion of AUM, asset under management, 10 trillion USD, broadly 75% of that is equity, 16% is fixed income, and 9% is commodities and others. So it's equity oriented, skewed towards equity. The India story is something similar. I'll share the numbers. In terms of geography, this 10 trillion US dollar is spread across the globe, with 70% market share by US,
Okay.
16% by Europe, and 14% by Asia Pac and rest of the world.
Okay.
As of end of March 2022, the global ETF industry has around 8,800 ETFs and ETPs. So there are close to 9,000 options or choices that someone has to buy or sell when it comes to ETFs. And these are by more than 590 ETF providers listed across 77 exchanges across 62 countries. So that's how penetrated and deep the ETF industry is globally. Coming to India, the growth story, the growth trajectory in India on the passive AUM side has been phenomenally encouraging over the last 5 to 7 years. Uh, the Indian ETF AUM, which is equity plus debt, put together is around 4.1 trillion, including commodities and including index funds. It has already crossed 5 trillion recently, which is 5 lakh
Wow.
crore INR. And these are numbers as of March 2022. And this number, which is around 4.1 trillion for equity and debt ETF and 5 trillion put together for all passive formats, has grown at a phenomenal rate of 43% year on year from 2008 onwards, over the last 14 years. 43% every year. This is how, and a large part of this has grown over the last, I would say from 2017 onwards, over the last 5 years, it has grown 9 times
Oh wow.
in terms of AUM. Yes. Now, uh, broadly, if we were to, identify what are the major reasons for this growth, one is, of course, the low cost format in which you can own an ETF as against maybe direct investing or maybe buying an active fund. So broadly, it is a low cost of ownership. It's more economical to take exposure to the capital market through an ETF route. And other than the advantages that I spoke of ETF as compared to index funds and active funds, the major reason has been EPFO, which is the
Yeah.
Employees Provident Fund Organization, took a decision somewhere in 2015 to start investing in equity market through ETF route. So, all of us are working, we draw salaries, and some part of it is deducted as provident fund,
Yeah.
and that money is managed by EPFO. So, for most of us, it is EPFO, and that money was predominantly for a longer period of time was invested in bonds and fixed income. In 2015-16, EPFO took a decision to start investing in equity markets, and there they took a call to not stock select but invest through ETF route. So,
Okay.
that has uh, that was the starting point of this growth trajectory, where every year uh, the incremental cash flows of EPFO, initially 5%, then 10%, then 15%, and now there are talks that it may increase further. So 15% of all the cash flows that are generated through EPFO through subscribers is invested in equity ETFs. So that's one big reason for this great uh, growth in the ETF AUM over the last 5 to 7 years. Other reason, if I can put it, is if you look at large cap active funds, uh, what has been observed empirically is that their ability to outperform the benchmark uh, is has come down. At least that has been observed empirically, that most of the funds are not
Yeah.
able to beat or outperform their respective benchmark, and this is more particularly true for active large cap funds. Now, that does not mean that large cap active funds as a category is not outperforming the benchmark. Of course, there are a few funds that are outperforming, and there are a few funds which are underperforming, but most
Yeah.
of them are not
Absolutely.
able to outperform on a year on year basis, consistently over a longer period of time. Uh, and even if you're outperforming for 1 quarter or 1 year, you may not be the outperformer next quarter or next year. So there's no consistency of outperformance
Yeah. No
in
guarantee.
active funds. And even if someone outperforms, for someone like me, a common man like me, it's very difficult for me to identify which fund is going to outperform this year. So it's
Yeah.
very difficult. It's very difficult. Uh, so if over a longer period of time you're not able to identify active funds which are going to outperform, uh, can you still continue to get exposure to the capital market through a low cost vehicle like an ETF, which over a longer period of time gives you decent return, and you save on cost, because the cost that you save every year compounds and benefits you over the longer period of time. So if you're not able to generate an alpha of 1.5%, when I say I mean the investor in terms of choosing the active funds, if you're not able to do that,
Yeah.
then might as well save that 1% in the cost and let it compound over a period of time, and take exposure to the capital market and earn beta returns. So beta returns is returns similar to the market, and
Yeah.
alpha returns is returns over and above the market, over and above the beta return. So if you're
Yeah.
happy with beta return over a longer period of time, uh, uh, then you invest in ETFs and index funds. So that's been another reason for ETFs and index funds to really grow in terms of size over the last 4 or 5 years. Today, equity ETF as a percentage of total active and passive equity AUM in mutual fund space is already 20%, which means
Wow.
the equity AUM of mutual fund, 1/5 of that is already passive. Uh, and if I talk about all forms of asset classes, equity, debt put together, that number is around 13 percent.
Okay.
And the good thing, Arup, is that we have a lot of choice in India in terms of where to invest through ETF. Today, there are around 121 ETFs as of March 2022, compared to 8 ETFs in March 2008. So
Wow.
it has increased 15 times uh, over the last 14-15 years. Uh, I'll give you a quick landscape analysis of the Indian ETF space in terms of what choices are there segment wise. You'll be surprised to know today there are there's one passive product, at least one passive product, either an ETF or an index fund on 89 indices, as many as 89 indices. So Nifty 50 being one of them, and of course, Nifty 50 is the most popular with 2 trillion or 2 lakh crore INR of AUM tracking Nifty 50. But there are 88 other indices on which there's at least one passive product available in India. I'll quickly give you a summary of how these 89 indices are spread, how these 121 ETFs tracking 89 indices are spread across segments and their sizes. So broadly, the 4.1 trillion of ETF AUM in India, uh, 3.5 trillion out of this is equity, and around 60,000 crore is debt. Now, I'm only talking about equity and debt. I'm not talking about commodities. Out of the 3.5 trillion, so there are 54 benchmarks in equity. So there are 54 equity indices which you can take exposure to. This is all index providers put together. 104 ETFs available, 104 equity ETFs available, and 17 debt ETFs available. So that sums up 104 plus 17 is 121 equity plus debt ETF. Out of those 104 ETFs which are equity, 46 are broad based, 39 are sector or thematic put together, 6 international, and 13 strategic. These are numbers as of March 2022. It would not significantly change as of today. Uh, the broad based category is the most popular category in India with 2.75 trillion INR of AUM. So out of 3.5 trillion of equity ETF, 2.75 is traditional broad based Nifty 50, mid cap 150 kind of ETFs. 60,000 crore of AUM tracks sector or thematic indices, around 8,000 crore of international, and around 1,500 crore of strategy or factor based indices. So that sums up the 3.5 trillion of equity ETF. The 60,000 crore of debt ETF is largely target maturity. 53,000 out of 61,000 crore is target maturity. So I was talking about target maturity ETFs. For a layman investor, debt funds has always been an unknown territory. Uh, because of the launch of the target maturity ETF, this territory is now explored by retail investors. So someone like me who would invest in a fixed deposit wants to know what is my kind of return that I will earn, and when will
Yeah.
I get my money back without redemption. These are the two things that retail investor can
Yeah.
connect with. How much will I get, and when will I get my money back? Fixed deposit kind of mindset. So I think target maturity ETFs has kind of cracked that code by saying that, one, because it's a target maturity, it has a particular redemption date when the investors' money will be given back to them, and because it predominantly follows a hold to maturity strategy, there's no churn effective, there's no active churn in the portfolio. There's a high amount of predictability of returns in terms of the yield that the portfolio carries. So before making an investment, by looking at the index, you know what yield the index is carrying, and there's high amount of predictability of returns. And of course, on one date, which is the target maturity date, the fund ceases to exist and gives the money back to the investor. So you don't have to redeem your money. Your money will be given back to you on a particular date, and that's the beauty of target maturity ETFs, which is the largest category of ETFs in India. So maybe I'll pause here. This sums up this sums up the global and the India landscape and the reasons why ETF is doing well.
Aman, I must say, your every time you say a number, your face lights up. Like इतनी खुशी दिखती है आपके चेहरे पे when you talk about ETFs, about different numbers, about how many are there globally, about what are the AUM numbers, what are the split numbers. Like I must say, you really, really love ETFs. Like I'm like बहुत खुशी हुई देख के ये कि you're so passionate about ETFs, and I think that passion is flowing through the screen. So because I am feeling it, and I hope other people in the audience are also feeling that energy and that whole vibe that you're giving out. Thank you so much for this.
So
But coming back to
I consider myself fortunate that I am witnessing a growth which is unprecedented. Uh, I consider myself lucky that I am in this market at a time when this market is growing and I get to witness it. And of course, I'm passionate about it. Thank you.
amazing. But yeah, going back to all of these numbers that you said about so many options being available, how does a retail consumer evaluate ETFs? Like, how does one say which ETF should they invest in? कैसे पता चलेगा उन्हें?
Okay, so uh, I agree there are a lot of choices available, and it may also confuse a layman investor. So the decision has to be made based on certain factors or certain aspects to be taken into consideration. The first one is you take a call that you want to invest in the capital market, and let's talk about equity to begin with. I want to take exposure to the capital market. I want to stick to large cap stocks only, for example. So I'm building a case now. I don't want to invest in mid cap and small cap to start with, for example. So you identified, let's say, an index like Nifty 50,
Okay.
which is the stock of the nation. It has top 50 stocks of India, which covers more than 65% of free float and full MCAP and liquidity of the all the stocks listed on NSE. So I want to take exposure to Nifty 50 now. Now there are 36 passive products available in India which are tracking Nifty 50. Uh, Almost half of them are ETFs, 18, 19 ETFs, and the rest of them index funds. So out of 18, 19 ETFs, if I want to choose, all of them track Nifty 50. So all of
Yeah.
them are clones of each other in a way at an academic level. How do I select which one to buy or which one to use to take exposure to Nifty 50? So there are
Yeah.
a couple of things that you need to be aware of. One is the beauty of ETF is that it allows you liquidity intraday, and that is one reason why liquidity of the ETF is very important. So how liquid the ETF is, and how do you know liquidity? One is what is the trading volumes of that ETF on the exchange, so that if you were to buy or sell at any point in time, the counter is liquid. That is one. Another measure of liquidity is the bid and ask spread. Now, the bid and ask spread is nothing but at what price can you buy, at what price can you sell at any point in time. There will always be a gap between the two, which is what the market maker would quote. So the market maker at any point, so market maker is a person who is willing to give you liquidity at any point in time. So if you want to buy, he's willing to sell. If you want to sell, he's willing to buy, and he or she would do that at a bid and ask at any point in time. So the bid and ask spread, which is the difference between the bid and ask, should be as narrow as possible. That is also a measure of liquidity. Wider the gap between the bid and ask, more illiquid that ETF is. Narrower the gap, higher is the liquidity. And finally, the size of the ETF, which is the asset under management, because that is directly correlated with the liquidity. Higher the size, there is a possibility, potentially, there's a possibility that the liquidity is also higher, but it's not always true. But you should also look at the secondary market liquidity. So that's the first major aspect, which is liquidity. Second is cost, the cost of ownership. So if all of them are giving me exposure to Nifty 50, then maybe I can look at the cost of ownership, which is the total expense ratio, and other things being equal, lower the fund management fee or the total cost of ownership. I would prefer that. other things being equal. And the third and the most important factor to measure the performance of an ETF is something called as tracking error. Now, the key objective of any ETF or any passive product is to closely replicate the performance of the index. How do I know whether the fund has given a return which is closer to the benchmark or not? There's a scientific metric for that, which is called as tracking error. Now, quickly, the definition of tracking error is it's a standard deviation of daily differential returns between the fund and the index. But for a layman like me, this number sums up how a fund manager has replicated, how closely a fund manager has replicated the index. Ideally, the tracking error theoretically should be zero. If the tracking error is zero, it means that there is absolutely no difference in terms of how the returns of the fund and the ETF and that of the index. Practically, there could be some nominal tracking error, but other things being equal, lower the tracking error, better is the replication of the ETF vis-a-vis the index. So these are the three components that anyone should look at. Just to summarize: liquidity, cost, and tracking error, and now tracking difference also, which is simply the difference between the returns of the fund and the returns of the benchmark. So tracking error is the fluctuation in returns, and tracking difference is the absolute difference between the uh, returns.
Okay. So while you were giving us this answer, I was checking up my balance because I'm so excited about, investing in ETFs for a change. But before I invest, like any person would have the question, what are the risks? Like it sounds all too perfect and great, but surely there are some risks involved in investing in ETFs, right?
Sure, sure. So, uh, one at one level, one risk is uh, uh, that if I invest in ETF, I will always match the return of the index. I will never outperform. Uh, so that's at one level. There is this active versus passive debate. That what if I invest in passive or ETF, I will lose my alpha, lose my excess returns. Uh,
Yeah.
and it's a never-ending debate globally and in India in terms of active versus passive. We strongly believe it has to be active and passive, and not active
Okay.
versus passive. So there has to be an asset allocation discipline at the first place, wherein someone like me, for example, would invest maybe the core portion of my investment. So I'm sure all of you are aware of the core and the satellite approach, where the core portion, which could be 70 to 80% of my investment, could lie in the low cost, broad based, traditional ETF passive format kind of exposure, where I continue to get, which is long term in nature, continue to get exposure to the market. And the rest 20-30% of my portfolio, where I want to maybe take higher risk based on my risk appetite. I may, flirt with either active funds or thematic or strategy kind of ETFs. Go beyond the basic and experiment with that. That's the satellite approach, so that I don't lose on the alpha, which I was worried about. That is one. Within the passive space, what are the risks of ETFs? One is liquidity. The benefit of ETF is liquidity. The drawback of ETF can also be liquidity.
Yeah.
And that's why I said it's very important for the ETF to be liquid, because the reason why you chose an ETF over an index fund or maybe of an active fund is you wanted to do an intraday volatility play. You wanted to buy at 11 o'clock and maybe sell at a second day at 2 o'clock, maybe. And you'd be able to do that only if the counters are liquid. And if it is not liquid, then there is a risk, because you may not be able to sell it, or you may be able to sell it at a higher impact cost. So impact cost is nothing but the difference between the quoted price at any point in time and the price at which you are eventually able to buy or sell. The difference is because of illiquidity of the ETF. So ideally the impact cost should be close to zero, but if the ETF is illiquid, there's a possibility that the impact cost is higher, and that's the risk of the potential risk of ETF if the counters are not liquid. Uh, Other risks that I can think of. could be tracking error risk, which is while you believe that you invested in an ETF which is tracking Nifty 50, uh, there is a possibility that uh, the replication is not perfect, and because of which there is a tracking error. Now this tracking error could be positive or negative, which means you may end up getting returns which are lower than the benchmark or higher than the benchmark. Either
Mm.
ways it is not good, because your objective was to get a returns which are closer to the benchmark. So that's another risk that you, which is more of an operational replication issue, fund manage
Oh.
at the fund management end. But again, we've observed that the tracking errors are not significantly higher. So, but it's always good to bear this in mind that there could be a tracking risk. Now, of course, these are risks very unique to ETFs and passive formats. The common risk, which is to all the formats of investments, is the market risk, which is that if the market falls, whether it is passive or active, everything will fall.
Yeah.
And that's something that everyone should bear in mind, which is a risk which is common to all forms of investment, which is the market risk.
Okay. Yeah, I think that fairly sums up, what the risks are. I think in the news I read about some SEBI circular about market making. Can you talk a little bit about that and what its impact is in the ETF world?
Sure. So I think uh, SEBI has done some phenomenal work in terms of promoting and encouraging the passive space. Uh, the first such circular was out in 2019, and that talked about how debt ETFs and debt index funds can replicate a benchmark. Uh, and after that, recently in May 2022, SEBI published a more comprehensive circular which talks about, how passive can be promoted and what needs to be done. And they rightly published certain frameworks which would, in my opinion, encourage passives. And then I'll just talk about few of them which I believe are really path breaking. One is the introduction of the passive ELSS category. So
Mm.
equity linked saving schemes. All of us been investing in that to save taxes at the end of the year,
Yeah.
and the choices that we had were all active in nature. Now SEBI has allowed mutual funds to also launch a passive ELSS. Of course, an AMC has to choose between the two. They can either launch an active or a passive format, but at least there will be a choice given to the investor that if they were to invest in an ELSS category, if an AMC launches an passive ELSS, that will give a choice to the investors as well. I think another thing is that the nomenclature of the ETF and the index fund would now have to mandatorily follow the nomenclature of the index, which brings more clarity in terms of what the strategy of the ETF or the index fund would be. Uh, Things like making it mandatory to disclose tracking error and tracking differences would also help layman investors to evaluate these ETFs and index funds better, because these numbers would be handy. So I would know how close the returns are to that of the benchmark. I think ETF broadly is still evolving, and awareness needs to be created. And for that, I think now there's more focused effort, because now the in terms of, see, okay, let me build a background here. ETFs are low cost, and there was a 2 basis points of investor awareness charge applied on all funds. Now, for passive funds, it will be 1 basis point instead of 2 basis points, and there'll be focused campaigns on creating awareness about, particularly about passive, which is in my which I think is very good. So we would retail investors would now come to know what ETFs are because of these focused campaigns. And finally, on the debt side, there's a lot of action on the debt ETFs. I think after the success of the first corporate bond ETF in India, which is the Bharat Bond ETF,
Yeah.
which tracks the Bharat Bond indices. They are first of its kind. I've spoken about the target maturity structure. These ETFs follow the target maturity structure. I think after the success of Bharat Bond, there are there have been many launches of target maturity ETFs in India, and that's why it became more important uh, to maybe harmonize and standardize how these ETFs track the benchmark, and that's why more flexibility uh, has been given in the newer framework that SEBI has published in terms of how a passive fund, can replicate a benchmark. So the earlier circular was the starting point of the earlier circular was full replication. So if there are 200 ISINs in the benchmark, the first step of replication, of course, there was a waterfall, but the first step of replication was to buy all 200 ISINs. But now SEBI has given a framework which allows maybe more flexibility to the fund manager in terms of replicating a benchmark, which is also the global model. Globally, also, global fixed income indices have thousands of bonds, but the funds may have maybe hundreds of bonds while replicating the same risk attributes of the index in terms of rating, maturity, issuer, sector, and stuff like that. So, SEBI has also mandated frameworks which have restrictions on sectors, ratings, issuer, maturity mix, and all. So while they've done that, but they've also given more flexibility in terms of how a fund can replicate a benchmark, which in my view is very encouraging. For a market like India, where the fixed income is really shallow and not very liquid, it becomes increasingly more important. So in all, I think this regulation, this circular, is path breaking. It will set the path for passive products and more particularly for debt ETFs going forward.
Awesome, awesome. I have actually exhausted all my questions. I had a long list which I thought would last, but your answers have been so comprehensive that you've answered other questions as well while you've been answering some of my questions. So I'll dive right into the Q&A, and some of our guests have been posting questions on various platforms. I'll take the first one. What's the minimum investment value for ETFs?
So it's one unit of ETF. So just the way you buy one stock, one unit of stock, you can buy one unit of ETF, whatever is the value of that ETF.
Okay, and just for example, how low could this be?
This could be as low as 100 rupees.
Okay, wow, that's
So, and
amazing.
that's the beauty. That's the beauty of an ETF. So, for example, when I buy one unit of ETF, and for simplicity, let's assume it is 100 rupees, uh, of let's say, and let's say that it's a Nifty 50 ETF. It that 100 rupees is giving me exposure to 50 companies, which, and if I were to buy even one unit of those 50 companies, one unit of share of those 50 companies, I would never be able to buy at least with 100 rupees or 200 rupees.
Yeah,
Uh, and so that's the beauty. With as low as 100 rupees or 150 rupees, I can get exposure to 50 companies. Of course, I can buy more if I want, but for as low as 100 rupees, I can get exposure to 50 companies cutting across 15 sectors in India.
nice. That's really amazing. And what's the taxation structure for ETFs? How is it similar or different to other asset classes?
So it is absolutely, broadly in terms of income tax and capital gains tax, it is similar to any form of investments in capital market, which is either through mutual fund or direct investing. In terms of equity-oriented ETFs, the short-term capital gains tax. So the short-term, long-term definition for equity is 1 year, and for debt it is 3 year. So if it is a short-term capital gains tax, then it is taxed at 15%, wherein your holding period is lower than 12 months. If your holding period is more than longer than 12 months in case of equity, it is 10% without indexation. The first 1 lakh rupees is exempted, and anything beyond that during a financial year is taxed at 10% without indexation benefit. For debt ETFs or debt funds, where the holding period definition is 3 year. So if your holding period is less than 3 years, short-term capital gains is what you make, and that money would be added to your income, and depending upon your income tax slab, you will be taxed. If it is long-term capital gains, which where the holding period is more than 3 year, then it is 20% with indexation benefit.
Okay, okay, that's very very helpful. Some of the people listening in have been asking about what are the brokerage, STT, and other charges? On brokerage, I can comment that it's the
Yeah.
same as equity brokerage, whatever the brokerage is there for the equity. On STT and other statutory charges, would you be able to highlight how they would compare to equity?
I would encourage the users to go to the exchanges website and look for the STTs. They change across time and across asset classes. So I would encourage them to
Okay.
go there and look there.
Okay. And can these ETFs? So one of the things that a lot of I have been a trader, and one of the things that traders love to do is pledge our mutual funds for collateral. Is that possible to do it also for ETFs?
Yeah. So based on the eligibility norms, even ETFs can be pledged to receive collateral margins.
Awesome, awesome. And how does just one last question would be, how does one measure the performance of an ETF? Like you mentioned earlier, how one evaluates an ETF.
Hmm.
But what's if you just purely had to measure the performance over historically, how would you do that?
So, there are common indicators or common measurement indicators which you would use for any form of investment. One is the returns, the historical returns that investment has given, and the volatility, which is the risk metric. And of course, you have the risk return combinations in the form of Sharpe ratio, tenor ratio, and stuff like that. You look at the alpha that the investment has generated, which is nothing but the excess return. So if an ETF has given, let's say, 13%, and your opportunity cost was 12%, then you earned 1% alpha over your opportunity cost. These are indicators or metric which are common to all forms of investment. Some metric or indicators which are unique to ETFs, I think one is tracking error, which we spoke of, because the
Yeah.
key aspect of ETF is tracking an index. So how closely you're tracking the index, tracking error, tracking difference, and software aspects like cost and liquidity also help in evaluating an ETF. So what is the total cost of ownership in an ETF, and what is the liquidity of an ETF? I think these are the unique indicators to evaluate any ETF.
Okay. One last question. I'm not as an investment advice or a financial advice. Everyone should consult their own financial advisor. But you personally, how much of your portfolio allocation would you keep in passive funds such as ETFs?
Okay, so the answer is interesting because uh, initially when I started investing, maybe 15 years ago, uh, I believed in my capability of identifying outperforming active funds, and
Don't we
started
all?
with investing because we believe that we have that knack of knowing which fund will do well, knowing which stock will do well, and stuff like that. I'm sharing my personal experience. And a large part of my investment was in active funds. Uh, there was a rotation of active funds because every year, different active funds were outperforming. So I kept churning. This year I bought this active fund. And that year I bought another active fund. So initially, a large part of my investments was into active funds. More recently, I think over the last 4 or 5 years, I consciously invest only in passive funds. Uh, at least in the large cap space, and a large part of my investment is in the large cap space. So I would say around 75% of my investments, both existing and incremental, is in large cap, which is Nifty 50 and Nifty Next 50 passive funds. Another 5 to 10% would be in factor or strategy based passive funds like momentum and alpha, just to satisfy that quest for alpha. And the rest of it is in debt, which includes liquid and ultra short. So that's the kind of mix that I have.
Awesome. That's about all the questions we had for now. We could cover it now. But I would just like to say, the kind of information, the kind of insights that you've shared with us today, you should definitely consider writing a book on ETFs because all of this information is really precious. And I, for one, am now become a strong believer in ETFs. and you could keep inspiring more and more people by through writing a book and sharing your knowledge. For now, for sure, I will buy ETS and do an SIP and definitely evaluate them and see what would be the best way forward. Thank you so much for taking out time on Friday evening. Thank you, Aman. Thank you, everyone listening in. We'll catch you soon another time.
Thank you, Arup, for having me. Thoroughly enjoyed it. Thank you.